Most people think the earned income credit is only for family with kids, but here a surprise. Even if you don't have children, you could still qualify for hundreds of dollars back in your 2025 tax return. The big beautiful tax bill didn't make the credit bigger, but it changed all the rules that can work in your favor. And if you plan ahead of 2025 and 2026, you can still put more money back in your pocket. So let me show you how. Hi, I'm Mia. I am a tax professional for more than 15 years, and I have family, small business owner, and landlord save money on their taxes and file with confidence. Today, we are breaking down the earned income credit. So who qualify? What's the limit, or what the new law did and didn't do, and how to plan across multiple years and keep more of what you earn. So first, let's talk about what the earned income credit is. So the earned income credit is a refundable credit, meaning it doesn't just reduce your tax bill, it can actually turn into a refund. It's designed for a low to moderate income worker with earned income from wages or self-employment. It doesn't apply to investment income like rental or dividends. The amount that you can get depends mostly on whether you have qualifying children. So family with kids can receive thousands, but workers without kids are limited to much smaller amounts. So look at some number for 2024. Here's the update. So with no kids, the maximum credit you can get is $632. If you have one child, it could get to $4,213. If you have two kids, it could be $6,960. If you have three or more kids, it could be $7,830. And then there's the income limit for no kids. So if you have no kids, for a single, the income limit is $18,591. If you marry filing jointly, that's $25,511. There's also an investment income cap of $11,600. And for a childless worker, you must be at least 25 but under 65, live in the US for more than half the year, and not be somebody else dependent. So now let's talk about what you're all waiting for, what the big beautiful tax bill did and didn't do, right? So first of all, the law did not increase this amount. The childless credit is still capped at about $600, but here what it did change. So the deduction for tips and overtime pay, deduction for car loan interest on certain US built vehicles, temporary senior deduction, and adjustment to SALT and other areas. And for the earned income credit itself, the IRS still will start requiring more checks against duplicate claims, and may face in pre-certification for some taxpayer. That's about compliance, not bigger refunds. Why this still matter, even though credits for worker without kids is small, it's refundable. Many people miss out because they don't file or assume they don't qualify. For example, Maria is 28 years old and earns $17,000. She qualifies for about $600. That's not life-changing, but it pays for groceries and utilities. Another example, John is married and earns $24,000 with his wife. They are under the limit and also qualify for about $600. It's not $1,000, but it's extra cash in their refund, money they wouldn't get without filing. So let's talk about some planning tips, because this is where you really make a difference, right? So tip number one, watch out for your income. If you are close to the limit, a little bit less extra over time, or an extra 401k contribution, or you can do traditional IRA, so it can keep you eligible. Tip number two, use the new worker deductions. So tips and overtime pay are particularly deductible now, which lowers your income and could help you qualify. And then tip number three, you're gonna think multiple years. You might qualify for the credit in 2025, but it's spaced out in 2026. So with some smart planning, you can shift income, adjust retirement saving, and keep the benefit 1 year while setting yourself up for the next. And then tip number 4, manage your investment income. So if you are close to the 11,600 cap, you want to time your stock share sales or dividends across years so you don't lose out on the credit. Tip number 5, file even if you don't have to. If you have wages and are under the limit, file return, otherwise you're leaving money on the table. To make planning easier, I have created tools and templates at productions.sc.com. They help you track income, calculate credits, and stay organized for filing. And if you want deeper training and strategies, visit assetwiseinstitute.com. That's where I teach tax planning to help you get ahead. Here how it looks in real life. Let's look at an example. So Samantha earns $18,000 in 2025. So she qualifies for about $600 in EITC, which is earned income credit, right? But in 2026, she expects to make $20,000 because she's a hard worker and she do some overtime. So without planning, she spaces out, but if she contributes $2,000 to her retirement plan, her income drops back to under the limit. She can keep her credits, bill saving, and lower her taxes at the same time. So that's smart planning across multiple years. So the earned income credit is still here, and while it's small for workers without kids, money is worth claiming. The big beautiful tax bill didn't raise the amount, but the new deductions for tips, overtime, and more give you fresh planning opportunities. So with good strategy in 2025 and 2026, you can combine these rules to maximize your refund. Have you ever claimed the earned income credit before? Drop yes or no in the comment. I want to see how many of you are learning about this for the first time. If this was helpful for you, hit subscribe, like, and share so more people can benefit from this. And check the link in the description for tools, template, and training. I'm Mia. Thanks for watching, and I will see you in the next video. Mahalo!